We've all heard the statistics about how half of all businesses go under within 5 years, but do you know why? It's not because they can't find customers or employees. It's not because they get into some huge legal battle. It's not even that they're losing money. It happens because they get into situations that we call cash crunches. According to a report published by US Bank, when businesses fail, it's a direct result of mismanaged cash flow 82% of the time. They fail because they do not have the cash on hand to meet their immediate financial obligations. They choke out. It's like drowning 3 inches below the surface. So in this video, we're diving into 5 of the most common causes of cash crunches and the steps you should take to avoid them. Now, a couple thoughts before we dive in. A lot of people mistakenly confuse profitability and cash flow, and this is a really big problem because they're different. Talk to your accountant for a more nuanced understanding, but the gist of it is this. Profitability is all about whether you can sell your services for more than it costs you to produce them, right? Revenue minus variable expenses gives you your gross profit, and you minus your overhead, that gives you your net profit. I'm simplifying a little bit, but you get my point. Cash flow, on the other hand, is completely different. It's all about the timing of cash inflows and outflows. So just as an example, think about an average month in your business, right? On a Tuesday, you collect a progress payment from a client. Yay! Oh, just kidding, that check actually bounced. On Sunday, you go to run payroll and surprise, it's 20% higher than usual because of all the overtime that you forgot your crews did. Monday morning comes around and your vendor calls, let's just say the lumber yard in this example, and they need 10 grand this week to keep your account open. You're in overdraft. Well, luckily for you, you finish a massive project tomorrow and you're gonna get paid and it's all gonna be good. Or will you? Will the customer have a punch list that's a mile long and delay paying you as a result? So here's where I'm going with this, guys. Cash crunches happen when an onslaught of cash outflows happen at or around the same time that a bunch of expected inflows do not happen. It's a pinch point, right? And every year we see otherwise profitable companies go out of business because of bad cash crunches. So how does this happen and how do we avoid it? Let's dive in. The first and most common cause of a cash crunch is poor or non-existent cash flow planning. If you don't understand where your cash is coming from and going to, how much of it is flying around and when, it's shockingly easy to unintentionally land in a cash crunch. Now, a cash flow plan addresses cash coming in and cash going out of the business, and it's concerned with your cash position, not so much profitability. That's what your budget is for. That's what job costing is for. That's what all the other tools and trackers that we talk about on this channel are for. Now, as far as cash flow plans go, here at Breakthrough Academy, we've built a very low tech and easy to use plan that you can grab for free. You can download it using the link in the description. Cause number 2 is seasonality. Now, the seasonal nature of many contracting businesses here in North America can mean that at certain times of the year, your cash inflows dip while your overhead does not. Now, forgetting about that whole off-season part of the year may seem like an egregious oversight, and in many cases it is, but hear me out. Every single year, we help businesses who misjudge how much they need, or they have a large and unexpected expense come up, AKA taxes, or for some other reason that they couldn't predict, are caught running out of cash while their operations lie dormant. Big problem. So the solution to this is that cash flow plan that we mentioned before. That's huge. Accurately forecasting your cash needs through the slow season. It's gonna help you sleep at night, but more importantly, if you do need to figure out some financing to get through that, it's a lot easier to have those conversations with the bank earlier rather than later. The second thing I would say is just do not make that rookie mistake of spending money to save on taxes. We've talked about this in other videos, but unless you have a very high level tax strategist who is carefully advising you, these are almost always really dumb decisions and they're gonna catch up with you. Okay, cause number 3, unfavorable payment terms. Look, unfortunately, contractors don't have the luxury of getting paid up front. Wouldn't that be nice? When they land a job, most of the businesses we work with are taking a deposit somewhere between 0 and 20%. If you're building bigger stuff, you might take progress payments. If you're building smaller stuff, maybe not. But it's a risky business because, to put it really simply, you foot the bill of the build before the client does, right? That leaves you incredibly exposed. So the solution to this, there's a couple. One, front end load your payment terms. John Warrillow, in his book Built to Sell, which I recommend, talks about front end loading your payment terms. Now, you're gonna have to make this advice work in the context of your own business, but if you can, the idea is this. You wanna collect as much cash up front as possible. You wanna collect more through the progress of the job, and you wanna leave the smallest amount possible still owing upon completion. This does two things for you. One, it smoothens out the cash inflows over the project life cycle rather than having this piddly deposit at the beginning and then this massive lump sum at the end. And it reduces your downside should, heaven forbid, the client stiffs you, they go bankrupt, or they flee the country. And guys, this stuff happens all the time. You do not want to be the schmuck in this situation. The flip side of this is you also need to be mindful of when you pay your bills. Paying early or before it's due, it may seem like a noble or nice thing to do, but it actually puts you in a pretty risky spot unnecessarily. And what you want to do in most cases is hold your cash, right? Pay when the bill is due, not a moment sooner. A good accountant, by the way, should be able to help you set up a really predictable, really reliable accounts payable system that you can then communicate to all your vendors and all your subs so they're on the same page too. Cause number 4 is slow invoicing and no AR systems. Not being paid on time for services delivered sucks. It happens to pretty much every contractor out there, and it can be extremely frustrating. Having said that, in many cases, it's the contractor's own fault because they forgot or they got too busy to invoice. You can't get paid until you deliver the bill, so deliver it. Now, that's only half the battle. We all know that clients, GCs, developers, or customers of any kind love to take their sweet time paying us, and this can create huge cash crunches downstream. So the solution, you need to put someone in charge of accounts receivable follow-ups. If you can, tie performance bonuses to payments collected or keeping outstanding payments under a certain amount. Make sure this is handled. 2, automate where you can. QuickBooks and most other accounting softwares have features built in that help you invoice and remind customers to pay their bills automatically. Use those tools. 3, if a customer won't pay you, don't be afraid to get respectfully nasty. Use demand letters, use liens to ensure you get paid. If you don't understand your lien rights where you live, check the laws in your province or state or consult a lawyer. Remember, it's your money. Go get it. Our 5th and final cause of cash crunches is rapid growth. Look, growth is fun, it's exciting, and we're all for it, but it's also sneaky expensive. Investing in marketing, team building, expanding services, taking on bigger and riskier projects, new equipment and vehicles, all of this stuff has massive implications on your cash position. And if you're cavalier about it, you can and will grow yourself right into bankruptcy. Because look, you need cash to pay for these things now, but you won't see a return on your investment until later. And if that later happens to be much later than originally planned because the market shifts, your sales forecasts were off, a key employee leaves, or any one of a million other reasons, you will be caught holding the bag. So there's a couple solutions for this. Let me walk you through this. 1, maybe just slow down a little, right? We're huge advocates for growth, but we want to do it in a stable and safe way. Ask a contractor who's doubled their business every year for 5 years in a row if they would do it again that way. 9 out of 10 of them are going to scream at you, hell no. Second, work with a company like Breakthrough Academy. All we do is systemize contracting businesses for growth and guide entrepreneurs through this exciting but risky stage of their journey. And to be honest, we've gotten really freaking good at it. You can check us out using the links below. A few pro tips to close out, okay? 1, be as lendable as possible and keep a sizable line of credit available at all times. Of course, not touching it is the hard part, but maintaining some level of liquidity through good debt facilities is always a smart idea. Number 2, just be disciplined, guys. No shiny objects. Like, do you really need the new F350 just because they released it? I'm not saying don't treat yourself. I'm not saying don't make capital investments. Just be smart. Number 3, spend more on your accountant and your other financial advisors. Not all accountants are created equal. Many are bozos. Make sure yours isn't. These are dollars well spent. So as we wrap, guys, those are the 5 most common causes of cash crunches and some tips on how to avoid them. Cash crunches are common. They're super easy to fall into. It's going to happen to you at some point. But if you have a plan and you understand the pathway out, it'll just be a blip on the radar.